Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing legendary investor Rick Rule of Rule Investment Media, as well as Battle Bank. How you doing today, Rick?
Life is good, Daryl. The better to be on with you. Thanks for having me.
Yes, indeed. I always love these conversations, because we just get real, and sometimes the audience enjoy it, sometimes they hate it. So hopefully we don't get hate for free this time. But I do want to talk a little bit about this is in connection with the dollar, because in your view, the dollar is going to lose 75% of its value over the next 10 years. And so I was thinking about the current administration and some of their policies, because it seems like there's some, they want their cake and they want to eat it too. One, we had the Doge efforts come in to reduce government waste, fraud, and abuse. And then we had the tariffs come in, which the tariffs were supposed to be to drive investment into United States industry, infrastructure, manufacturing, to reshore jobs and everything. But right now they're talking about giving out $2,000 checks and $10,000 checks to those who were who were affected by the shutdowns. And so it kind of just seems like the same tricks that the pony does. And so just curious, is that in your view for how the dollar is just going to continue to erode because of the spending habits of these politicians?
Absolutely, Daryl. We're starting off strong. They're going to hate us for this. The checks are bribing us with our own money. Let's be straight. What they do is they steal it out of our paycheck, and then they give us back 10% of it, signed by Trump. It's amazing that so many of the American electorate are stupid enough that they can be bribed with their own money. Doge is predictable. The Department of Government Efficiency was toothless. I'm old enough to remember, Daryl, the Reagan Revolution. Ronald Reagan came into office with an overwhelming mandate. He didn't win by an eyelash like Trump did. He had an overwhelming mandate to reduce the size of government. And he employed a guy named David Stockman, who you met at my conference in Boca Raton last year, to head the Office of Management and Budget. And despite the popular will of American citizens in 1980, the professional political class derailed the Reagan Revolution in 6 months. They made mincemeat of the Trump administration, who was never in favor of lower spending anyway. He wanted to divert resources from circumstances that benefited other people's constituency to circumstances that benefited his constituency. Mm-hmm. He was never about less government. He was always about different government. And it's always that way. Elections were described by, if my memory serves me well, Ambrose Bierce. It may have been H.L. Mencken. Elections were described as advanced auctions of stolen property. The process doesn't change. The high bid changes. It might be Biden. It might be Bush, it might be Obama, it might be Trump. But the truth is that everywhere and always, they seek to bribe you with your own money. If they benefit you accidentally. You need to look after yourself. And Daryl, in an advanced auction, the loser is always the young person or the unborn person. The deterioration in the purchasing power of the U.S. dollar will impact nobody as seriously as the unborn. My generation, the baby boomers, voted ourselves all kinds of cool benefits and services, but we forgot to pay for them. The consequence of that is that the net present value of unfunded entitlement liabilities in the United States exceeds $120 trillion. Trillion dollars. And it gets worse. That's why I say that the deterioration in the purchasing value of the U.S. dollar is an inevitability. We have two choices, Daryl, as a consequence of politics. One, we can be honest like the Argentines and default. Or two, We can do what America did in the 1970s, which is default on the installment plan. Keep the nominal value of the promises while inflating away the net present value. I think we choose door B. I've lived through it before. I know how it happens. I know how it ends. And I'm doomed to live through it again. Forewarned is forearmed. Hopefully, over the course of the next year, you and I in our discussions will tell people how to arm themselves so as not to be taken advantage of by the situation, and hopefully, in fact, to take advantage of it.
Mm-hmm. Yeah. So, how much of this is? It seems like this is a American problem. Oftentimes you have each political party pointing fingers at who's doing what, and they both do the same thing. They both want to spend money. Deficits are ballooning. National debt continues to go up. And then you have the voters who want what's going to benefit them, whether that be a check in the mail, signed by whichever president, whether that be a tax cut, whatever the case may be. You have the voters that vote based on these policies that benefit them too. And obviously there's like some underlying dynamics with, the policies that were carried out for the hollowing of our industrial base and real wages not increasing over time over the last, 30 years, 40 years or whatnot. And so, and I was listening to a clip from Milton Friedman, and Milton Friedman was clearly saying like, well, part of the problem is that the people vote for these benefits that they want, but ultimately it creates this problem where we have the debt continuing to rise. It has to get financed, fiscal dominance, all these different things, which are ultimately like inflationary. And so it seems like there's very few people that are kind of aware of these things.
I think you put your thumb on it, Daryl. The one argument I would have for you is that inadvertently you described it as an American problem. It's a political problem. The Canadians have the same problem, only a little worse. It's a global problem. When I say the U.S. dollar loses 75% of its purchasing power, I don't mean against other currencies. I mean absolutely. I think the U.S. dollar will do okay, maybe not well, but it will do okay against a basket of currencies. But this is a national problem. In Canada, they have, I think it was called the Department of Regional Economic Expansion, which basically is an agency that steals money from the West and delivers it to Ontario and Quebec. So this theft of private wealth and the distribution of private wealth to favored political constituencies is not unique to the United States, but rather is a feature of politics. Ambrose Bierce, again, a quote. This is Gore Vidal. Politics is best understood by examining the root words. Poly from the Greek for many, and tick from the English colloquial for small blood-sucking insects. The process of politics is understood by examining the root word, many small blood-sucking insects, each trying to steal the lifeblood from the other while they defend themselves from having their own lifeblood stolen. That's what an election is.
Yeah, for sure. So how much of this is actually, do you think is real? So like we have this initiative to bring on like manufacturing, to bring industry back. We've had multiple issues with the rare earths and such. I mean, now you have silver, copper, and many other minerals that are put on the strategic minerals list, critical minerals list, and such. And then you have the government that are actively investing in private companies, taking stakes in private companies and such. And so, I've been kind of thinking about that, like, okay, how much of this is like going to come to fruition? Because it seems like it's going to take years and decades to even build out, as the Chinese have been building their infrastructure for a long time. And so curious if you have any thoughts there.
If I was to be charitable, Daryl, I would say it's well-intentioned fraud. But I think it's worse than that. I think about myself as an example. I've been investing in natural resources and critical metals now and energy for 50 years. I don't think that Trump is a better steward of my investment capital than I do. I don't think I need him as a money manager. I think if you took the 16 elements that compose the rare earths on the periodic table as an example, that Mr. Trump couldn't spell any of them. So the idea that he's going to invest my money for me is something that I object to rather strenuously. In terms of the dearth of investment in the United States, I'm not a politician, I'm not an economist, and I could solve the problem beginning tomorrow. Literally beginning tomorrow. Let me explain. The U.S. tax code is consumption friendly, not investment friendly. If you and I were to build a mill in socialist Sweden, the tilt-up concrete building that we would build to house the mill, we would expense against our taxes in year one. In China, we would expense that in year one. In Russia, we would expense that in year one. And in the United States, we amortize it over 33 years. Guess where you build the factory? I don't want Trump to give me money. I want him to leave me with my own money. We could reestablish the American industrial might in 10 years if we reformed the tax code to make it once again investment friendly as opposed to consumption friendly. What we have decided to do in the United States is to steal money from people who generate wealth to distribute it to people who consume wealth. All admirable, something that curries the favor of the people who consume more than they generate, but not the way that you establish industrial capacity. You raise workers' wages, and real wages have been in decline in the United States for 35 years. You raise workers' wages by educating them and allowing them to employ more capital. Think about the difference between somebody who operates a front-end loader and somebody who digs ditches with a pick and a shovel. The guy who operates the front-end loader operates a $750,000 piece of equipment, but he replaces 100 or 150 pick and shovel workers. It is cheaper to employ the machine operator at $40 an hour than it is to employ 100 pick and shovel workers at $7 an hour. You restore America's industrial capacity and competitiveness, and you restore America's wage rates by changing the tax system in a way that aids capital formation and allows American industry to allow its employees to employ more capital. It's as simple as that. Politically, that's extremely unpopular. What we would rather do is eat our cake than have our cake. The consequence of that is that we're coming into a period of time where cake becomes very, very scarce.
Yeah. So just thinking about gold in this picture, obviously as the dollar continues to be devalued based on the money printing, excessive spending, M2 money supply. I mean, we even have the Fed cutting rates as well as pivoting on some of the quantitative tightening and injecting some liquidity into like the repo market and such. And so it just seems like a recipe that this train just keeps going. And I'm thinking about gold in terms of like where are we headed with that? So like, because I obviously continue to store my wealth in gold, continue to buy, save in gold and such. Even in our state, they just implemented a tax on the purchase and sale of gold and silver, which is interesting because gold and silver is money in the Constitution, and so they're taxing money, which is interesting. And so I've even found kind of my ways around that. And so just curious in your perspective on gold and where we go from here.
I think gold is a must-own asset, and I wish I didn't have to say that. Gold has served its purpose for at least 1,000 years, but likely longer, as being both a medium of exchange and a store of value. Gold does well during periods of time when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. We've already talked about why people need to be concerned about that, because there's a guarantee that your purchasing power in fiat savings instruments deteriorates. With gold, at least you have a chance. And it has evidenced itself as a superior store of value for at least 1,000 years. Importantly, too, with the advent of technology, gold is becoming at once a store of value and a medium of exchange. And let me explain. When you, Daryl, go to buy physical gold at a dealer, whether or not it's in the state of Washington or not, you're probably paying a 3% premium on the buy side and a 3% premium on the sell side. In other words, your transaction cost is 6%. But increasingly, with the availability of digital coins representing gold deposit receipts at places like Tether and elsewhere, you will be able to do that same transactions for fractions of a percent, which means that you will again be able to use gold as money. You'll be able to go to Starbucks and buy a cup of coffee in gold. And Starbucks will be able to aggregate all of those fractional payments and, if they wish, surrender those coins for physical gold, which means that gold increasingly in the future will be at once a medium of exchange and a store of value, which is another reason why I think you have to own gold. On the one hand, to defend yourself, and on the other hand, as a recognition of the fact that gold will once again fulfill a role in society that it hasn't fulfilled since the 1800s, which is to say, simultaneously a medium of exchange and a store of value. It's very difficult for me to understand why a rational human being wouldn't have a substantial gold portfolio.
Circa 2020, we pivoted the entire company, turned on its head, brought in new management, George B., our CEO, who's built gold mines all over the planet, and we focused in on CK, copper cake. It was not reliant on drill holes and discoveries. We can go through this process, engineering, permitting, get towards a development stage asset. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Mm-hmm. Yeah. So you bring up interesting topic because for me, obviously the Tether has the coins. It's pretty much like a tokenized gold where you buy, a token and you get a right to like an ounce of gold or whatnot. Obviously that introduces like another level of counterparty risk. And for me, like I've been thinking about risk in a lot of ways because one, I had too much metals in my home, and so then I opened a depository, and so then it was like, okay, I need to spread some of this risk out. But then even thinking further, like maybe I spread some more risk out with some of the tokenized gold, such as Tether or some of the other services that sell those. And so just curious in your perspective on diversifying the risk of your gold holdings. I mean, I haven't even got to the point where I'm thinking like overseas and such. I mean, that's kind of like another level to it, but just curious in your perspective there.
You have to assess risk and reward as it applies to you. I'm delighted that you no longer have physical metal in your house, Daryl. There's a different risk there. That is that you would be invited by somebody who you wouldn't normally invite over for lunch, somebody who was carrying a pistol. So I'm delighted that you obviated that risk for you personally. I think you and I talked about that in the past.
Yeah.
One needs to familiarize yourself with the Tether product. My understanding is that the Tether product is not 100% backed by physical gold or silver, although I don't need to know that to be the case. If you are concerned about if you're willing to own a gold surrogate as opposed to physical gold, if you want to lower your transaction cost and not have to be worried about physical storage, there is always disclosure of conflict of interest. The Sprott product. The Sprott product is 100% backed by physical. Institutional holders can redeem their trust for physical units, which reduces and often eliminates the arbitrage. In other words, makes the underlying security track the gold and silver price much more efficiently. And the transaction costs on the New York Stock Exchange are de minimis. So the first level of risk reduction is if you want to obviate the transaction cost, the storage cost, and the insurance cost, is probably the Sprott product. I am, as I say, unfamiliar with all of the specifics around the Tether product. I am unsure as to whether the Tether stablecoin is 100% backed by physical gold or silver, and whether or not one can surrender the XAUT for physical gold or silver. If that feature isn't present, either Tether will add that feature or somebody else will create a coin that will allow you to do that.
Mm-hmm.
Probably the most secure form of storage would be in a vault that was owned by a publicly traded company, so that you could assure yourself that the balance sheet and the income statement of the vault owner precluded you from experiencing the risk of the vault owner stealing your gold or silver. At Battle Bank, my bank, we have insisted that our own gold and our customers' gold be stored at Brinks, precisely because we don't want them to store the gold at home, where they could experience personal security risks, but also because my memory of the 1970s was that a lot of people trusted their gold and silver to storage facilities that then either folded or stole the metal. And I don't want to experience that risk. A third thing that you could do, and I've done this in the past, is store your physical gold and silver in a safe deposit box in a depository institution where you have access to it. From a practical point of view, what I found, at least, is that it's inconvenient. In my particular case, I stored the gold in Vancouver, and I would buy it at one bank where it was cheaper and walk it down the street and deposit it in another bank, which was at once dangerous and inconvenient. Gold is heavy. And I paid the commission, both going and coming. So although I still have a fairly small amount of physical gold held in a safe deposit box, a legacy of my own laziness, I have more physical gold stored at Brinks, but I have the overwhelming proportion of my gold, silver, platinum, and palladium holdings represented by depository receipts in the form of the Sprott physical products.
Mm-hmm. Okay, got it. Yeah, that's kind of interesting. So obviously Brinks is a huge, institution, and they do. I was kind of doing some research in terms of like Brinks versus other depository vaults and such, and so
You're
I
okay
kind
with Brinks or Loomis, frankly.
yeah,
It's just that when Battle Bank went out to tender, Brinks provided better service to us than Loomis.
got it.
Our
Okay.
hope is that eventually we will be able to store our customers' gold in any facility worldwide that's publicly traded and that adheres to the audit procedures that are insisted on by Battle Bank.
Mm-hmm. Okay, got it. So what's your perspective on? So there's obviously bullion dealers that have vaults and depositories and such, and they're insured as well. So what's kind of the risk there? I mean, I think there's risk in everything, but
I have no interest in storing my gold or silver in vaults that aren't publicly controlled.
Mm-hmm.
Many of the best bullion dealers give you an option of which facility to store in. And they often emphasize vaults that they themselves have better custodial arrangements with. Meaning it might be that they charge you 50 basis points to store your gold or silver, while the vault is charging them 10 basis points. And they're making a 40 basis point spread on you. The consequence of that is that their spread is predicated on you storing your gold in a facility that isn't publicly controlled, which is to say a facility where you don't have access to the balance sheet and the income statement, where you don't understand anything about the solvency of the institution that stores your gold and silver. To me, that's an unacceptable risk. The higher quality bullion dealers worldwide will allow you the option of storing your gold or silver either as allocated or unallocated product, and they will allow you the option as to whether you take physical delivery, which I wouldn't do, or choose between the facilities that you store it in. And I would insist personally that my storage be accommodated in a facility that was publicly owned.
Okay, got it. Yeah, appreciate that. Okay, so just transitioning a little bit. So you mentioned that when you were taking some profits off the table, you were trading some alpha for beta, and this have to do with the equities. And so I do want to kind of go through some of the royalty and streaming companies as you rank many portfolios, and there's many levels to this. And so I know you're a big fan of like Wheaton and Franco Nevada and such. And so I want to start with just some of your rankings on some of these companies because they do mitigate a lot of risk. They do trade at a premium. And before we even get into the actual companies, there's this perspective that there's little to no growth in this particular sector. And so I want to get your thoughts there because I know that many of these companies have a lot of exploration projects that aren't producing assets yet. And so I want to get your perspective there.
Well, you made two great points there, Daryl. The first is that royalty and streaming companies are lower risk alternatives to exploration producing companies. The structure of the business is that you don't have a direct interest in the gold or silver mine, which means that you're not responsible for the capital cost, the operating cost, or the sustaining capital costs. You just get the money. Your gross becomes your net. From a general administrative cost perspective, too, operating gold mines is more expensive than not operating gold mines. Companies like VRIC and Newmont have huge staffs of geologists, engineers, accountants, stuff like that. The royalty and streaming companies don't have to have that because they don't operate things. So they're cheaper to operate. They're better businesses. And they're not sort of better businesses. They're way better businesses. That's important. The second point that you made is important too, which is to say when Bay Street and Wall Street look at the streaming companies in particular, they see a business that grew over 30 years on large transactions, and they believe that the large transactions are over. And that's wrong. The large transactions are increasing, and I'll tell you why. Gold and silver cash flow in a royalty or streaming wrapper trades in the market at 14 or 15 times cash flow. Base metals cash flow as part of a producing company changes hands at 5 or 6 times cash flow. What that means is that the gold and silver byproduct from a copper mine is best owned by a royalty and streaming company. A royalty and streaming company can pay a disproportionate amount for that portion of the mine's revenue that comes from gold and silver rather relative to copper. The copper industry estimates, and I just heard this number in London, it surprised me. The copper industry estimates that they will need to spend $250 billion in the next 10 years to maintain current production in a market where demand is increasing at 3% compounded. They're not talking about keeping up with demand. They're talking about maintaining current production. $250 billion. Now, the industry would appear to be, in terms of their access to free cash and credit, about $100 billion short. Where will that money come from? Lenders and streaming companies. The transactions that you will see in the future, building out $7 or $8 billion porphyries, will mean that there will be an equity stack. Equity is part of the capital stack. There will likely be offtake capital contribution. There will likely be conventional debt. There will likely be subordinated debt, and there will almost certainly be a stream. And these transactions, the sale of precious metals byproduct streams from copper mining development, means that there are literally tens of billions of dollars of opportunity available to the precious metal streaming community from copper construction activities alone. The second facet of growth will be the consolidation of the mining industry and the precious metals mining industry. We're going to see a wave of M&A, billions and billions and billions of dollars of M&A. The cheapest form of quasi-equity is in the streaming space. And you will see, as you recently saw in the transaction where Hemlo was bought from VRIC, an important component of the compensation of the buyer to the seller will be accomplished by way of a stream. The third area of growth will be resource nationalism. Countries around the world would like to own larger parts of the producing assets within their countries. But many of the countries who desire these larger stakes don't have any money. They're precluded often, but not always, by international convention from stealing those interests, so they have to buy them, but they don't have any money. How do they do that? Well, I suspect in the future, increasingly, there will be an accord between the company having the asset and the country that wants to own part of it, where the divesting company will finance the national interest partially by way of the sale of a stream. So in those three circumstances, the financing of base metals projects, private sector M&A, and public sector M&A, I think that the opportunities available to the streaming industry dwarf the opportunities that we've seen over the last 30 years.
Okay. Yeah, thanks for sharing that. So let's go ahead and go through some companies, and I just want to get your idea for your rankings. You rank a lot of portfolios and such, and so you all be sure to submit your portfolios to Rick at ruleinvestmentmedia.com so that he can rank your portfolio. He's done thousands of rankings, and so let's start with some of the tier one companies. So I want to get your ranking on Franco, Wheaton, and Royal Gold.
For the record, today's interview is taking place on the 17th of December. I say that because rankings are ephemeral. They're a snapshot in time. Something could happen in the news 4 weeks from now that completely obviate my ranking. So don't watch this discussion in June of 2026 and think that the ranking is current. Now let's get back to the question. Franco-Nevada is the best of the best, the finest precious metals investment on the planet. Despite the fact that it's done extremely well, I have it as a 4. Rankings are 1 to 10, 1 being best, 10 being worst. For the record, I've granted 11 number 1 rankings in 35 years of ranking stocks. A one ranking is extremely rare. Wheaton, I also have as a 4. Very, very, very high quality company. No longer silver centric, but still about 40% of its revenues silver related, which means that the financial results in the future, given the doubling of the silver price over the last 12 months, will surprise people whose expectation is rooted in the past. What were the other names? I'm sorry, Daryl.
Royal Gold.
Royal Gold I just upgraded to 4. It has sold off a bit as a consequence of the Sandstorm acquisition, which I believe was a good acquisition. My hesitancy around Royal Gold used to be the concentration of the company on a very few assets and the weakness in its midstream growth. It obviated both of those concerns with their recent transaction, so I have it as a 4 as well.
Okay. So obviously the risks are a lot different for these companies. These companies are, multi-billion-dollar companies. They're the biggest and the best. Let's go down another tier. Let's talk Triple Flag.
I have Triple Flag as a 4 with a temptation to upgrade it as a 3 as a consequence of price performance. Triple Flag is what I would call a mini major. There's a tier of companies below the majors. Triple Flag is at that space. Much more systemic risk than the big companies because they have fewer tier one assets, which means that their revenues are unstable. It also means that it's easier to grow them, and they're selling at lesser multiples. I have Triple Flag as a 4. I'm very positively inclined to Triple Flag, and I've been adding it to my own personal portfolio.
Okay. Then we have Aura Royalties, formerly known as Cisco Royalties.
Uh, Probably on fundamentals, the cheapest of the majors. Two tier one deposits, which means that you don't have the same reliance on tier two or three or tier three deposits. Also, what looked expensive but turned out to be a relatively fortuitous acquisition of the royalty portfolio of Orion, which is to say, at the point in time that they bought it, they paid a very full price. Then the gold price doubled
Hmm.
and made that acquisition look much more attractive. Again, I have it as a four.
Yeah, it's hard to get past the four. So triple flag is the only one that's potentially going to be upgraded to three. Just depends.
Listen, if the prices of any of them get weak, understand that this is a function of price to value. If
Yeah,
the price goes down, which scares people, it excites me. A
yeah,
bear market is a sale. It would be easy in market weakness to see this whole sector upgraded to a three.
got it. Okay, let's go down the chain a little more. So here, obviously, the companies are younger, newer, smaller, and such, and so obviously there's a little more risks there. But let's get in it. So Elemental Altus.
I'm going to go out on a limb. The stock has done well. I have Elemental Altus as a three.
Three.
You have seen some price weakness as a consequence of some Elemental shareholders selling and some EMX shareholders selling. That has been offset by a private infusion of $100 million, pardon me, into Elemental Altus by Tether and the promise of access to more capital should the company need it. I believe there's going to be a consolidation of the tier three space. And I believe that the finest of the tier three royalty companies is Elemental Altus. In addition to having access to capital and the discipline to make intelligent acquisitions, through the EMX side of Elemental Altus, the company has the ability through prospect generation to create their own royalties, not to have to buy them, but in fact to make them. I note with some pride that I'm a founding shareholder of EMX. That is, I owned it pre-public. And I was a founding shareholder of Altus, one of the roots of Elemental Altus. So I go back with this company 25 years, and I can speak with real fondness as to the corporate culture on both sides of the merger.
Okay. Yeah, that's good to know. So sticking along that same line of Tether and Tether taking investing in multiple streaming companies, we have Tether recently invested into Metallo Royalty and Gold Royalty. So I want to get your perspective on those two.
I have Metalla as a five, and I have gold. Well, I have Gold Royalty as a five now, as a consequence of recent share price escalation. They're both fine companies. They're both companies that the market has treated fondly. I should tell people that my five and above rankings, despite the fact that five is a middle of the road ranking, my five or above rankings constitute 25 or 30% of my over rankings population. So a five might appear to the normal person to be a neutral. I personally own many fives.
Hmm. Yeah, I mean, it just speaks to like there's no perfect company. I mean, it's very rare. I mean, I think Ivanhoe was the one for you like a long time ago, and you did really well with Ivanhoe and Robert
Yeah,
Friedland,
it
and
speaks to the fact that I'm an old cynic and I'm a very harsh grader.
yeah, yeah, for sure. Yeah, that's good. So let's talk about Empress.
I have Empress as a five. I recently downgraded it from four simply because the stock has performed so well. I love the
Yeah.
company. I own lots of it. I bought it because it was selling at half of its intrinsic value, and I believe that they had a definitive competitive advantage with their relationship with Endeavor Financial. Endeavor Financial, for those of you who don't know, is one of the premier financial arrangers for mine construction development worldwide, and having access to the capital stacks constructed by Endeavor Financial is the durable competitive advantage that Empress enjoys. In addition, Empress enjoys access on an as-needed basis to the technical staff at Endeavor Financial, meaning that unlike its other peers, Empress doesn't need to employ full-time geologists and engineers, but rather accesses them for pay as needed. These are
Mhm.
big advantages.
Yeah,
Those
that helps a lot with the G&A costs, right?
those big advantages are compounded by a very focused, very smart CEO. The reason I downgraded the company from 4 to 5 is simply because the share price is up 400% since I bought it.
Yeah.
Rankings are always a function of the juxtaposition between price and value.
Hmm. Yeah, for sure. I remember engaging with Alex and Empress the first year at your symposium. That was back in the first year I went, which was in 2023, and I think they were trading at a little less than 30 cents at that point. And so, yeah, the performance has been amazing.
Corporate performance has been good too. Uh, it's just not as cheap as it was then.
Yeah, agreed. I wish you would have nudged me and like load the boat, Daryl, load the boat. I wish
Well,
you
I
would
was
have nudged
trying
me.
at that point in time, Daryl. I was trying to get you to load up on beta, not alpha. I want to take a young man who had to who had to provide for his son 30 years from now, and I didn't want you to take any risks at all. So
Yeah, yeah,
the
for
Daryl
sure.
Thomas that's in front of me today with a new career and a new net worth is somebody who I'll push a little harder in the future.
All right. I'm ready for it. I'm ready. Okay, so Origin, this was a company that you ranked on one of our episodes a long time ago. Was about what, a year or so ago, year maybe 2 years ago, and I think you had them at a 2 back then, and
I did.
the
I did.
performance just was amazing since then and such. And so, just curious in your perspective on them now.
A couple of years ago, they owned the Silica Cap royalty, a royalty on a deposit in Western Nevada that was shaping up to be a 10 million ounce or greater deposit. It was very clear to me that that deposit by itself was worth a substantial premium to the whole of Origin. And the whole of Origin also had another producing royalty, the Ermitaño. I believed at the time that the Ermitaño royalty was worth the whole market cap of Origin, and that the rest of their portfolio was worth half to two-thirds of the market cap of Origin, and that the Silicap royalty was worth twice the market cap of Origin, which is to say that I believe that the company could be broken up for 350% of the then share price. That's a pretty good deal. That's before any gold price escalation. And that's what happened.
Yeah,
Uh,
yeah.
they sold off the Silica Cap royalty. Huge win for shareholders. And they spun the rest of the company into the new Origin. The value proposition is less extreme now, but again, you have an experienced, honest team who doesn't have to buy royalties, but rather they create them. In particular, their future is in their own hands because the Ermitaño royalty generates enough money to sustain the company, earn a profit, and distribute a dividend while they grow.
Okay, got it. And so this company, the next company, I'm not as familiar with. Our mutual friend Benjamin mentioned them when I was having a discussion with him recently on the performance of the royalty and streaming companies. But Ecora Resources.
Yeah, Ecora has been a continued participant in the Natural Resources Investment Symposium, and it's a royalty company that I've owned for about 10 years. It's London listed, which has traditionally been a bit problematic because there wasn't a market for royalty and streaming companies in London, and the assets were non-London. They've addressed that with a North American listing, a Toronto listing. The other knock about it was that most of the revenues came from coal. That's a double-edged sword. What it meant is that they were enjoying a lot of free cash flow, and the market hated that cash flow. I didn't, but the market did. The strategy was that the company would use that coal cash flow to diversify into non-coal royalty streams, which they did with spectacular success. They built a portfolio of both producing and soon to be producing and non-producing royalties that relative to the price of the whole, relative to the market cap, was and arguably is still the cheapest in the space. Uh, the company has performed very, very well, but given the fact that the cash flow is derived mostly from materials other than gold, that cash flow hasn't been valued as highly as precious metals royalty and streaming companies have. The flip side of that is, like a different company in the same space, Altius Minerals. This company has access to a much broader range of royalties and can acquire cash flows at a much less extraordinary royalty while still enjoying the structural benefits that royalty and streaming companies have in commodity production. I have Acora as a 4.
4. Okay, then what about Altius?
I have Altius as a 4 with a potential upgrade to a 3. These guys are superb allocators of capital. What has been a drag on Altius, well, Altius had a huge benefit not too long ago from selling part of the same royalty that Origin did, and enjoying a $230 million win on a $1 million investment
Mm-hmm.
win. What has been a drag on Altius is that they have spent a lot of money on royalty and streaming investments in alternative energy and wind and solar. And these are long lead time investments. So the money has been out without the money coming back in. Much more recently, the money's begun to come in spades. And I think that the free cash flow that you see in Altius over the next 2 years from their investment in so-called green energy, by the way, not operating investments. They don't have the capital cost, all that kind of stuff. They don't have the operating costs. They just get the money. I think what you're going to see is increasing free cash flow, increasing return on capital employed, and also more clarity in the market about the relationship between the way you invest in alternative energies and how you get paid.
Mm-hmm. Got it. Okay, yeah. Thanks for sharing that. All right, so yeah, we're pretty much at time. So obviously, you're going to be at the Vancouver Resource Investment Conference. So if you're watching this interview, please click the link that's pinned in the comments. Come catch Rick live, as the event is free for you to attend. And anything else you want to share with the audience, Rick?
Sure. The best value for money I offer is in rankings. Go to ruleinvestmentmedia.com, list your natural resource stocks, and for free, pretty good value, I will rank them 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues if I think my comments might have value. Please no pot stocks, please no crypto stocks, please no tech stocks. Leave an old resource guy to do what he does best. Natural resource stocks, ruleinvestmentmedia.com, and yes, I will see you at the VRIC. I understand that I'm opening the conference on stage with young Jay Martin and 2 of my not young friends, Bob Quartermain and Ross Beatty. I promise that you'll get a good performance out of us.
Yes. Well, thank you for coming on the show, and look forward to connecting again. You all be sure to hit the subscribe button if you haven't yet, and click the link that is pinned in the comments to the Vancouver Resource Investment Conference. We will be there live in person. We'd love to connect with you. Thanks for coming on the show, Rick.
Always a pleasure, Daryl.